Okay, folks, got a new software package I'm trying to use to give you some more analysis of my retirement. One of the major topics that I get into with people, and I've left a few videos on this, but this will be much more analytical. And I think you will, learn from it. At least one man's journey on their retirement. So, this is Portfolio Visualizer that I'm using. And what I'm going to do is talk a little bit and show you the data around the managed funds that I use in my retirement versus the index funds. I love index funds. The index funds are safe. You don't regret any decisions. It's the benchmark you're always comparing managed funds to. But a little history on me. In 1987, I started with Alcoa and I signed up for a 401k, and I had this. American funds are what we use. So I signed up for these American funds, and I've been with them for 35 years now, 36 years pushing. And I really don't have good reason to stop riding this horse. And I'm going to show you that analysis. So, hey, let's take a look at Portfolio Visualizer. I'm going to go from 1985 to 2022, and I'm going to do various time frames. Okay, includes year to date. We're going to put $1 million in here. 1, 2, 3, 1, 2, 3, just for fun. I like management rebalancing annually. I didn't put the names. We're going to customize the name. Portfolio 1 is going to be indexed funds, INDEX funds. And then portfolio 2 is American funds, American funds. Okay, that way we'll have our title straight. And I'm going to hit analyze just to get that going. But so, hey, so you've seen what I filled out. So let's look at the funds. Okay, this is a Vanguard Total Stock Market Fund. I didn't use VTI because VTI only goes back to 2001. Okay, and I wanted a longer time period. I wanted to get the tech bubble inside of there. So this is the fund they recommended. It's a total stock market index fund, and I got 85% of my portfolio in that in scenario one. And then this is a total international fund. I got 15% in there. You may or may not have 15% in international. I like having it. This is what I would buy if I went all in on index funds and two funds, simple portfolio. This is what I would do. Yes, the last 10 years has been great, even 15, I think, for US based companies. But historically, if you go back and look at longer period of time, you'll see that there are quite a few decades where international does better. So I like having this in there. Okay. So then you move on to these other 5 funds. These are all American funds, and I'm going to walk you through each one of those. The first one is AMCAP. It's well managed U.S. companies looking at size, fundamentals, and solid growth potential. So their advisors, research people are looking at the balance sheets, looking at sales, looking at continual growth, looking at the product they're in, looking at the sales team. I mean, looking at the management team of the plant. New Perspective takes advantage of global trade patterns. There's a lot of that stuff going on right now. Investing in multinational companies with strong growth prospects. New Perspective is about 50% international. Growth Fund of America seeks stocks, cyclical companies, and turnaround situations where they see growth. So they're taking a look at places that, companies that may look like they're suffering, but they see a turnaround in their management team, their philosophy. They've sat down with them and they think they got good growth potential. And you pay for that. That's what's in the expense ratio. Washington Mutual is the next one. Uses strict criteria to analyze companies with strong balance sheets, consistent dividends. It's a growth and income fund. Fundamental Investors looks at undervalued, overlooked opportunities with high quality products, leading market share, an unappreciated growth opportunity, earnings, and dividends. So people going in and looking at the numbers, these are financial geeks going in, looking at the numbers and saying, hey, this is underappreciated. So my engineering background, I tend to like numbers. And I would like to bet on the company where I can see their fundamentals, see their management team, and look and project that they should do well. Now, will these advisors pick the right companies? I don't know. Let's see how they've done in the past. Yes, it's always safe. I love index funds. I don't want to say anything bad about index funds, but let's just see how I've done. So we're going to analyze these two portfolios. Got 20% each one of these funds, and they're basically the same. International, I think this is actually closer to about 17% international. So let's take a look at that, and you'll see that it only goes back to May of 96 with the Vanguard Total Stock Market. So we're really just starting in 97. Like I said, I wanted to get the tech bubble in there. And you take a look, let's move my face here. You take a look and you'll see that American funds beat by 1.5, 1.4%, let's say, a little bit more, 1.4%. You basically have an additional let's call it 1 million, 3.1 million by going with the managed funds, which has the expense ratios baked in. Standard deviation is a little better for American funds. Best year and worst year, let's call that equal. But it's the last since 25 years, it's been pretty sweet. Okay, so let's see if I'm cherry picking the data. Let's go from this 97. Let's start at 2000. This will be 22 years. And you see basically the same thing, 1.4% improvement, another, what's that? Let's say that's 4 million. So you're at 1.4 million better for using the managed funds. This doesn't fit the narrative. Okay, so let's go to 2010. Let's look at the last 12 years and do the analysis. So looking at our recency bias, they're essentially the same with a slight edge to American funds when you look over that time period. So, hey, let's look at the last 5 years. Let's just look at the last 5 years and see what's going on. The last 5 years, good. Did I do that right? Looks like American funds is, 1.5% better. Did I do that right? Last 5 years, 97 to 2020. No, 97. Sorry. That didn't look right to me. We're not doing 97. We're doing 2017. 2017 to 2022. And you'll see that they're neck and neck. So the last 5 years, neck and neck. But in every other time period, well, they're pretty close on 12 years. But you go back longer than that, American funds got a good track record going. Now you dive into that just a little bit. Let's just see. All right, everybody talks about the tech bubble, the lost decade with the great financial crisis. Let's pick. Let's get 1999 to 2010. Kind of get that whole time period, just to see how the managed funds did versus the index fund during this time of, really bad returns. Oh my gosh, look at that. 2.5% better, 2.5% better than index funds. So you had, let's call that 1.5 to, let's call that 2 million. You don't got an additional $500,000 in there. A little less standard deviation, not much. The highs and lows about the same. So, there's just when people say that index funds always beat managed funds, I kind of I'm going, man, I can't believe, what am I, the exception here? I think that's the case for a lot of them. I really don't know. I'm just a one-trick pony. I've got American funds, and I've had American funds. Every quarter, I sit down and I go through Portfolio Visualizer and say, okay, let's look at all, the same exercise. Let's go back as far as I can, the 97 and these funds that I've got, comparing to the indexes, look at all the way down to the last 5 years. I try not to look at year to date, because, if you just look in the year, you'll be whipsawing yourself all over the place. So look at historical track records. I also, this is a personal issue with me, I like looking at data. I like making decisions based on data. I respect managed groups that make their decisions based on data. They look at the balance sheet. Are they making money? What product are they in? What's the management team like? What are they invested in? And then make a decision. Is that a good company? Capital Group has done a great job for me over the years with that. Expense ratio 0.63 to 0.65 kind of range. Okay. I don't pay any sales charge. If you know something about the American funds, if you're buying them just on, in your brokerage account, you have to pay a sales charge. Well, in a 401k, you don't. And that's where I got started. And then once you accumulate $1 million, I don't pay any sales charge. I don't pay any transaction fees at all. Okay. So, if you're caught, in a place where you're not in your 401k, I wouldn't pay the 5% commission. I wouldn't do that. But, here's a group of funds that I think have done extremely well versus the index. It's always safe to pick the index, and there's nothing wrong with picking the index. I think about it all the time, but I don't have a good excuse to move. And I've got this pull on me that says data counts for something. These people are looking at data, and I'm paying them a modest fee. Expense ratio of 0.65 is pretty low compared to a lot of them out there. It's not zero. It's not 0.03 like some of these Vanguard funds. But, fundamentally, I don't have a reason to change. So I wanted to show this. I've made videos, talking about this, but I've never showed you the analysis of what I'm coming through. If nothing else, you learn here's a great tool, Portfolio Visualizer, takes into account expense ratios, dividends, all that stuff. You can do a direct comparison. Nice little charts coming out on it. I really love the software. I checked off everything that I had. Hey, let me know in the comments where you're listening from. I love it, love it, love it. So many international folks. I mean, I would say I think statistically there's 37% international folks listening to this channel. Also, if you disagree with me, if you've had bad experience with managed funds, good experience with managed funds, you're an index fund person, you're all that, whatever, let me know your experience. Let's all learn from that. Maybe you'll convince me to switch. Okay. But right now, I don't have any reason to switch. This is Joe out.